Howdy, who all my stock market gamblers? Welcome today. I'm Tall Mike. We've got a lot to talk about. Well, it's Good Friday. What's going on in the markets? Markets are getting ready to close. We're having a short trading session. Dow's up about 90, Nasdaq's down about 20. Not much going on. Everybody's on vacation. The real action should happen next week, right? When people come back from their vacation and the traders are back in the office. All right. So this rally we've had, it's been a 3-week rally and we've pretty much gone straight up, right? We're very overbought right now. I do expect to see a pullback. The reason I expect a pullback is this market was bought straight up on very low volume and a very narrow breadth. Only about 7 stocks have been pulling this market higher. So this market is due for a pullback. I do think they'll push it higher into the end of the year, but I do not think this is going to end well. I'm telling you, next year, I don't think it's going to be pretty. I know it's an election year. I still think the stock market's going to have a lot of trouble next year. We'll see how that plays out. All right. Let's get over to the real estate market now. Now, Morgan Stanley, they came out and they said the real estate housing market is poised for an improvement in affordability. Houses are going to become more affordable next year. Now, it's fascinating to me, their take on the market. They think the housing market is going to drop only by 4 or 5%, but they think the market's going to come down next year. But they also think interest rates, mortgage rates are going to come down next year. Now, I do think the housing market will drop next year, but I don't think the mortgage rates are going to come down. But the Fed's going to pivot. The Fed's going to cut. And that's possible. I believe they will cut. That doesn't mean mortgage rates are going to come down. Let me explain that. A lot of people don't understand that. You see, people think that the Federal Reserve controls the interest rates, and they kind of do on the short end. They can control the discount rate, the rate that they loan money to the banks at, but long term, the 20-year, the 30-year, where the mortgage rate money is, that's pretty much a market into itself. The Fed does not have control over that. If nobody wants to lend us money, those rates will go up. All right, so now we're coming in. Why will the Fed reduce rates? Why will they pivot, right? Do they have any reason to pivot? Right now, they do not. They're not going to pivot yet. They're going to wait for us to get into a recession. And when the recession comes, I do believe the Fed will pivot. And I do believe they will lower the interest rate that they charge we're about 5.25, and they will pivot and they will start to lower those rates because we'll be in a recession. Now, my take is we're already in a recession because we're starting to see the unemployment numbers go up. And it's much worse than that. You see, for every job loss, that's like paying, let's say, a couple $100,000, right? They go out and they lose their job. Well, they can't find another job, so they take 2 or 3 jobs trying to replace that income. So the unemployment numbers look better than they actually are. But even by the Fed standards, we've gone up 0.5% in unemployment from 3.4, I think it is, to 3.9. So unemployment rate's going higher. Now, next year, I expect that rate to actually reach 10%. We'll see how that plays out. A lot of you think I'm crazy for saying that. A lot of my takes, they're not popular. 10% unemployment is going to be very bad, but that will make the Fed pivot, right? That'll make the Fed pivot. But as we go into a recession here, what happens? When you're in a recession, the GDP goes down, right? The GDP goes down. The amount of money that the government collects in taxes goes down, but does our government really stop spending money? Well, actually, I don't think they're ever going to stop spending money until this blows up, and eventually it will blow up. But I think that when you get the GDP going down, the tax numbers going down, that they're going to have to print more money. You see, the interest rate right now, just the interest on the debt, we're about $1 trillion, $1 trillion. Next year, we're going to go to $2 trillion. And the trillions of debt right now, 34 trillion. But we're printing another $1 trillion every quarter. Every 3 months, we go another $1 trillion farther in debt. Okay, so that's about 4 trillion a year that we're dropping farther into debt. And they're going to keep printing money. There's nothing to stop them. Why would they stop? They're not going to stop until this blows up. And I do think it'll blow up. You see, a lot of people, here's the thing. They want you to look at the stock market. The stock market's going up, right? Well, actually, the S&P, it's right where it was 2 years ago. But what is not where it was 2 years ago? 2 years ago, the bonds were here, and now the bonds have come down. The bonds have dropped 40%. You can look at the TLT, that's the ETF of the bonds. Okay, so that was trading about 150 2 years ago, trading down here about 90, right? Okay, it's lost about 40% right now. And this is a problem. This is a problem for a lot of things. It's going to be a big problem for, well, commercial real estate. That's imploding. That's going to be a big problem. It's a big problem for banks. Banks that, there's been a bank run, all right, already. And I'm kind of proud of the public for getting their money out of the banks. Banks are not safe, but since SVB, Silicon Valley Bank, it went down, and we've had another 4 besides. So 5 very large banks have gone down this year. It's a Great Depression numbers. About 10% of banks failed, right? Okay, those would be numbers of the Great Depression. And there's going to be many more next year. I mean, maybe we hit 30, 40, 50, maybe as many as 100 bank failures next year. And they're going to call them mergers because they're all going to merge with JP Morgan. JP Morgan will probably be the last bank standing, but it may even go under. But okay, so there's been this bank run, right? I mean, you can look at things. And in brokerages also, look at like Charles Schwab. Charles Schwab, their stock for the year is down 30 or 40% already, all right? But they've lost $300 billion in deposits this year. $300 billion was taken out. That's a bank run, right? I mean, they're not really a bank. They're more a brokerage, but was taken out. Maybe they're in trouble. They're laying off 2,000 employees, right? Because they're cutting costs $500 million a year. And a lot of businesses are starting to lay people off and starting to cut costs. They call it cost cutting. Well, what's the number one cost that they cut? It's called wages, right? Employees, they lay them off. So there's a lot of layoffs coming, and that's what happens in a recession. A lot of layoffs happen. But Janet Yellen, she'll come out there and she'll tell you the economy's strong. The economy's strong. And she'll say, but Mike, look at the Treasury market. It's safe and it's liquid. Well, we know that Janet Yellen, her job is to lie. Her job's to lie. That's her job. I don't blame her for it. She told you the truth. We'd have all the bank runs. We'd be in a Great Depression right now if she told the public the truth. So she cannot. She has to lie. She has to say economy's great. She has to say bonds are safe and liquid. We're already seeing that you cannot trade the bonds in large blocks. There's no bid. It's called no bid. There's no bid on the bond market. Now that scares me a little bit, you see, because if the bonds are not the safe haven, that's where people would run into normally, and we may see the bonds, the bottom just might fall out of them, and that's eventually what will happen, and that will send rates much higher because nobody wants to buy the bonds, so there's no bid for them. Okay, now that doesn't scare me completely because, well, the government will just print more money, and the Fed, they'll buy the bonds, right? Okay, so we can pay the interest on the bonds. That's not where it gets scary. It gets a little bit scary with corporate debt. Oh, especially the zombie companies. Zombie companies, all right, so out of the S&P 500, we got about 20% of the companies, they cannot make the interest payment on the money they already owe. They're in debt. They can't make the interest payment without borrowing more money. But you see, these rates have gone from down here around 0% to, let's call it 8 or 9%. The zombie companies cannot refinance, right? And you get these things. You get these ETFs, right? The HYG is the ETF for, the junk bonds. Okay. And the junk bonds are what scares me. What happens when no one wants to buy the junk bonds? Well, there's no bid. So the junk bonds, they would come collapsing down and the rates would go higher, 10, 20, 30, 40%. Okay, because no one wants, because they know they can't pay it back. They know they're going out of business. When they go out of business, a lot of people get laid off. Okay, so, but it goes back to the Great Depression. Let me try to explain this better here. Okay, in the Great Depression, they had these things was called bucket shops. Now, what was a bucket shop? Well, the term actually started, it was like a dive bar where they sold beer in buckets. It was like a low-life bar. But people started gambling in those bars, and somehow they started to bet on the stock market. Isn't that weird? Okay, so bucket shops were where the derivatives took place in the 1930s. Today, the derivatives take place on the open market. You see, we have the HYG, but we have derivatives on that. Now, derivative is nothing fancy. It's a big term they like to throw around, right? Okay, so it's just like, okay, if you own Apple stock, a derivative would be buying an option on Apple stock, a put or a call, right? That's a derivative of the stock of Apple. All right, so you got the junk bonds. You have a derivative of is the HYG, right? Okay, that's the ETF. And sometimes you have double and triple ETFs, right? Double and triple. Now those, you're just getting out there, and then you have options on the double or triple ETFs. So you have derivatives, and then you have derivatives on the derivatives, and derivatives on the derivatives, and derivatives on the derivatives. And these are what was the bucket shops back in the Great Depression here. These are the modern day bucket shops. It's called the derivatives. And there's over a quadrillion, not a trillion, not a trillion. You'd have to get to a quadrillion in the derivative market. Now, when the derivative market freezes up and hits no bid, right? So sometimes people don't want the debt that the zombie companies owe because they can't pay back because they see the company's going to go out of business. Like WeWork went out of business. Their debt is not going to be paid back. So the zombie companies, the HYG, is going to reach a point where there's no bid. Nobody can buy it. Nobody can sell it. You can't get out. It's going to freeze the system up. This is what scares me personally. Okay, this will bring the system down. Now, I got carried away there a little bit. I don't mean to be all scary on, on Good Friday, right? But okay, so this is a huge problem, right? So we're coming into a recession, right? So tax revenues are coming down. Okay, so what's going to happen? Well, tax revenues are coming down. We're going to have to print more money to make up for the downfall in the tax revenues. So they're going to print money like crazy. $1 trillion every quarter will go farther into debt. Okay, but the debt, nobody's going to want the debt, right? They're going to demand more money. If we hit 50 trillion in debt, 60 trillion in debt, people are going to start to see that the emperor's not wearing any clothes. So they're going to demand more money to loan the government money. Do you want to loan the government money? Look, they can't pay the debt off. Maybe they'll print money and give you your interest, okay, but that money will become worth less and less that they give you back. So you're going to want more and more. As the money becomes less and less, you're going to want more and more interest when you loan the government money. So the long term of the bonds, it's not going to drop. Okay, so let's say we're at 5% here. It's not going to go down to 4.3%. It's going to go up 7, 8, 10, 12%. And what's that going to do to your mortgages? Mortgages are not going to come down like Morgan Stanley thinks that mortgage rates are going to drop next year. I think they're going to hit 10% or higher next year, maybe 12, maybe 14% by this time next year. Now, what's that going to do to houses? Now, a lot of people say that, but Mike, that's going to make the housing market explode higher. Nobody would sell their house and there won't be any inventory. So the housing market will go up when mortgage rates hit 14%. It's going to be great in my area. It's going to be a lot of fun. Well, I got the opposite view of that. I got the opposite view. When you get mortgage rates above 10, 12%, I think the house market is going to implode. It's going to drop by 30, 40, 50%. I know this isn't popular. I get those comments. People hate when I say this, but I really believe it. And it's nothing, it's okay that the housing market went up 40% in the last couple of years. That's acceptable. But for it to go back down to where it was, 40%, completely impossible. Ask any moon boy out there, the moon boys, they'll tell you that could never happen. Not in my area. There's no inventory, Tall Mike, and nobody dies. Nobody gets divorced. Nobody loses a job. My area is fabulous. We're only going to go up from here. We're going to double, maybe even triple. Maybe we hit, $2 million for the average price home. I don't buy into that. I really don't. I buy into we are in the middle of a crisis. We're going to have this big credit crunch. It's going to make mortgage rates go up. Yes, the Fed will pivot when they see the recession. The Fed will pivot, but it's not going to help this time. This time they're out of bullets. They're really out of bullets, right? Sure, they can print more money. They can print another 10 trillion, another 50 trillion, another 100 trillion. We then become Zimbabwe. Look, hyperinflation is not off the table. We're in the middle of a banking crisis. We're in the middle of a credit crunch. It's not over. I think we'll be okay till the end of the year comes. And then next year's where the fireworks start. But Mike, next year's an election year. There's not going to be any fireworks. They're going to make the stock market go up. They're going to make your house go up. They're going to make everything go up. And I hope they do. Maybe they can pull that off. I just don't believe it. Now, this is just my take. And I got a little carried away. It's Black Friday here. Anyways, get out there, everybody. Do some shopping if you want. Black Friday, the malls are crowded. Hit the subscribe button. Give me the thumbs up. We'll talk again next week. Bye-bye now.